Welcome to the 3 Edge Week in Review for the week of July 17th. I'm Fritz, Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. This week, Steve and I will be discussing why valuations matter when making investment decisions and why, in the long run, investment returns are inseparable from the entry price an investor pays for those returns. Here at 3 Edge, we believe that in the long run, in order to generate attractive risk-adjusted returns, it is essential to maintain a disciplined long-term approach, and in long-term, valuations matter. But before we get to that, let's just do a quick recap of the activities in the global capital markets. And so far, at least, July is shaping up to be a pretty good month for risk assets. And not only for U.S. equities, but also ex-U.S. equities, including Japan, which is enjoying its best economic growth in some time, and where inflation is ticking up. And unlike here in the United States, that's actually good news in Japan because it means that wages and home prices are both rising for the first time in decades. And as we know, investors like Warren Buffett are increasing their allocations to Japanese equities. Thus far, July has also been a strong month of performance for real assets. Gold is up, as are commodities. Investors were encouraged a few weeks ago when we got the most recent report on inflation, and that came out earlier in the month, and that showed inflation had cooled significantly in June. And that report was certainly good news for the Federal Reserve, which has been aggressively tightening policy as it seeks to combat inflation. And so the consensus now on Wall Street is that there will be another 25 basis point increase in short-term rates by the Fed at their meeting on July the 26th next week. However, with the recent positive inflation report, another rate increase in September is less certain. However, it's also important to keep in mind that the current tightening cycle may need to continue, since even though inflation has declined, it's still too high if you're going towards the Fed's 2% inflation target. And that can be a challenge to get all the way down to 2%. There was also some cautionary economic news this past week when a report from Bloomberg indicated that corporate bankruptcies are piling up at the second fastest pace since 2008. And the only other time between then and now that corporate bankruptcies were actually higher was during the pandemic in 2020. So, moving on. Let's get started, Steve. And we need to talk about the concept of value as it relates to investing and the concept of valuation. And I know that here at 3 Edge, we talk about our 3 Edges, our investment research process, and that's one of the foundations of our research is analyzing valuations. At the same time, we've talked for a while now, the U.S. market, particularly the S&P, for example, is significantly overvalued, and even at bubble levels, perhaps. However, obviously, we've seen the S&P power its way higher thus far in 2023. So I think it would be helpful to explain why we consider valuations to be such an important factor in our investment research and investment process. Does it matter that by our measure, the S&P is so overvalued? Why can't we just ignore valuations at this point and join in the fun?
Well, Fritz, I have to admit that if an investor was just a short-term trader, trading in and out every day or trading in and out frequently, then valuations don't matter very much. Most short-term traders ignore valuations. There's very little connection between the value or the price that a market is offering when you buy into it and what the returns are over the next day, week, or month. On the other hand, there's an incredibly strong connection between what the valuation is when you buy into a market and what the subsequent returns that market produces over time. And we have the facts to prove that. So let me introduce this chart. And it's a result of lots of research we've done on valuation to determine how strong is the connection between valuation and the return that you get over time. And what we found is that valuation is an incredibly strong and powerful predictor. Now, this research goes back analyzing the US market over the last 150 years. And let me explain in more detail what this chart is actually showing. First of all, we have to pick a measure of valuation that we think is the best predictor of future returns. We've looked at many people use different variations of data on what they consider a good valuation metric. And with all the research we've done, we found that the most reliable, best predictor is the price to sales ratio. And the price to sales ratio is simply the price per share, and in this case of the S&P 500, the price per share of the S&P 500 divided by the sales per share of the S&P 500. And by sales, it's the market cap weighted sales of all the 500 companies in the S&P 500. And so if the price to sales ratio is high, it means higher than average. It means that that market at that time, the S&P 500 at that time, is overpriced or overvalued. If the price to sales ratio is below average, it means that at that time the market is underpriced or undervalued. And what this chart shows, and I'll go into more detail, is that if you buy into the market when it's overpriced or overvalued, your subsequent return over the next 10 years is going to be well below average. And if you buy into the market when the price to sales ratio is underpriced or undervalued, your subsequent 10-year return is going to be well above average. And it sounds like common sense, but it's surprising how few investors take this into consideration, because often investors are so short-term oriented. They're jumping on whatever the market has done lately. What is the trend? Follow the momentum, fear of missing out on a rally, etc. And so oftentimes investors ignore valuation, and it's okay in the short term, but long term, it won't serve you well. And our goal is to help our clients achieve good long-term performance. So now, if we look at this chart, we literally took a snapshot of what the price to sales ratio actually was in the US stock market every month for the last 150 years. For every one of those snapshots we took, for every month, we looked at what was the actual return over the next 10 years and annualized that. We did that month by month for 150 years to see how strong the connection would be. And as this chart shows, it's an unbelievably powerful predictor of what actual returns will be. And on the left, you see in the first bar on the left, that is the bottom, or I should say, the bottom 10% of price to sales ratios. These are the 10% lowest price to sales ratios over the last 150 years in the US stock market. And you can see when the price to sales ratio is very low, or when the market's underpriced, and you bought then, your returns were much higher than any other time. Going all the way to the right, the top 10%, if you bought when the price to sales ratio was unusually high, then your returns over the next 10 years on average were much, much less. Today, even though we had a big correction last year and now we've had a partial recovery this year, today the price to sales ratio is 2.5. That's more than double its long-term average. It's almost as high as it was at the end of 2021, when the price to sales ratio hit an all-time record of 3.1. Just to put things in perspective, I mentioned the average price sales ratio is around 1.2. At the top peak of the tech stock bubble, right before it burst, the price to sales ratio was 2.3. We're actually higher today. So I can't ignore that. As a team, we can't ignore that. We don't feel responsible if we put all of our clients' money in the S&P 500 index, even though it would have been a lot of fun this year so far. You said, let's have a party. Let's join in on the fun. It would have been a lot more fun. But just keep in mind that even after this big gain this year, it's still not close to where it was even a year and a half ago or at the end of 2021.
Yeah, that's right. That's right. And I think the interesting thing about that chart is those are actual returns, right? That's not projecting anything. That's actually what happened. So it is very, very powerful. Okay, so very good, very interesting. So I'll just go back to what I said originally, which is that, so we are in this bubble territory. The market is continuing higher. Inflation's coming down. The job market remains strong. Consumers are spending. Corporate profits are holding up. So, it feels like the S&P could still go higher. So it begs the question, maybe this time is different.
So as I read stock market history, right about now in every bubble, someone says this time is different. Right. A famous economist, Irving Fisher, highly respected, came out with a quote saying that this time we've entered a permanent plateau of higher prices and productivity and profits. To paraphrase, that wasn't an exact quote, but to paraphrase. And he made that quote exactly 1 week before the crash of 1929. And he was a very eminent, respected economist. So emotions are tough. And there's no doubt that long after people say, look, the market is overvalued, there's no rule that the market can't become even more overvalued. And it's so tempting to want to jump in and join the party, as you say. So, and it's hard to be disciplined. And those that are disciplined win in the long term, but often suffer some pain or fear of missing out in the short term. So there's no question about that. Now, I want to introduce a famous quote from perhaps one of the most famous investors of all time, Warren Buffett. And he's paraphrasing his mentor, Benjamin Graham, who cut his teeth in the Great Depression and bought low when everyone was selling and rode a big rally after that. And basically, his message is, in the short term, the market is a voting machine, and in the long term, it's a weighing machine. And what he's getting at is, in the short term, a lot of investment is just what is popular, what is trendy, what is going up, what is feeling good. And that's why statistics show that most people put the most amount of money in at the market top, because that's when everyone's having a party, the market's going higher. And it can last for a while, no doubt, like you said. On the other hand, over the long term, the market's a weighing machine. When the market gets overvalued, even though it can become even more overvalued, it never stays there forever. It always eventually comes back to fair value. You need some catalyst to turn that psychology around, because right now you cannot justify this big market rebound based on fundamentals. Sales revenues are not going up this fast, earnings are not going up this fast, interest rates are not coming down to justify it. It's really psychology and momentum and trend following that's forcing the market up. And it can continue for a while. But over the long term, the market's a weighing machine, meaning that eventually it always gets back to fair value. Sometimes in getting back to fair value, it even overshoots and goes to undervalued and then comes back to fair value. So eventually fair value wins, valuation wins. And so what we're trying to do is to acknowledge the fact that this market could go higher. It is true that we're not completely missing the S&P market. We have a discipline where we know that our model, while it's been very effective over full market cycles over a long period of time, it's not always going to be in phase every day, every week, every month. And so we have these minimum and maximum ranges. So if the market goes up unexpectedly in our world, we still have some participation. And so even our minimum participation is quite good, and it's helping us keep up. Also, we did find another equity market that is a whole lot more undervalued than the U.S., or in relative terms, much more undervalued than the U.S. in relative terms, and that's Japan. And Japan had its bubble back in 1989, and everyone's been running away from it ever since. And it's become so unloved and so undervalued. Instead of the U.S. S&P 500 index, which has a price-to-sales ratio of 2.5, Japan has a price-to-sales ratio well below 1. And so it's more compelling. So there are other ways to invest.
Excellent. And that plays perfectly into my last question, which is always, based on what we've discussed here today about valuations, long-term investing, how might investors position their portfolios? I think you're getting at that most recently. How should people think about their portfolios now?
Sure. And I have to admit that there are a lot of investors who are feeling this, what they call FOMO, fear of missing out. Mm-hmm. Yeah. And that they just in case this goes up a lot longer, they want to participate. And there are relatively safe ways to do that. I mentioned one, which is getting into other equities, but undervalued ones. It is possible to, for instance, get into an index of global equities that might include some U.S. equities, might include some other equities, and in a very balanced, disciplined way, combine that with your more conservative approaches. Right now, we think that a lot of people are a little too confident that there's no more fear of recession, that the recession is gone, that inflation is gone. We see that inflation has come down, but the primary reason why inflation came down is because oil prices went from $140 a barrel a year ago to $70, and that really knocked a lot of the stuffing out of the inflation. Well, we're not going to get that over the next few months because we've already seen the big drop. The reason why we saw a drop was that our government sold massive quantities of its strategic petroleum reserves, and now it's actually at the point where it's got to rebuild them. So I don't think that's going to help the inflation rate anymore. The other thing is services have a big role with inflation. And wages have not kept up with inflation for a long period of time. And it's possible that this summer we're going to see increased labor activity. The Teamsters is talking about a big strike with UPS. The United Auto Workers are talking about a big strike. The actors and the writers in Hollywood are looking to strike. And this could have a bandwagon effect where we see labor activity. We see wage hikes for companies trying to deal with the labor unions. And that could keep pressure on inflation. In the 1970s, very similar thing happened. We had a spike in inflation. It came down. Everyone declared victory. And it turned out that was premature. Inflation, when everyone eased up and thought it was over, inflation started to go back up again. And then the Fed had to get interest rates even much higher than before. So we think it's still time to be cautious that we're not out of the woods. Try to keep your emotions in check. Be balanced. You don't have to be completely out of the market, but be balanced and have some dry powder for a rainy day.
Great. So I have a personal note on that. My son, who works a lot in the movies, had lined up to be working on a movie starting in August, and that's not going to happen now with all those folks that are out on strike. So labor is definitely flexing their muscles in here. So we'll see how that plays out. Well, Steve, thank you for your insight into how value and valuations are an integral component of successful long-term investing. I mean, very consistent. I mean, my takeaway during my career is that if you want to be successful over the long term, you have to consider the implications of valuations. In fact, you could argue that valuations are one of the primary drivers of long-term, meaning full market cycle investment returns. And this is the case even when, as you said, there are periods when they don't seem to matter at all.
Fritz, so, I want to just point out that
yes,
you wrote a paper some time ago that has received very high recognition, and that's Defense Wins Championships. It applies to investing. And something that paper really gets into is the mathematics of down markets followed by up markets. So many people this year think, wow, there's been a big rally. If you're not participating, you're really missing out. And yet they don't realize that when you look at the downturn of 2022, you look at the rally of 2023, you're still well behind where you were when you started in 2022. And we haven't even made that up. And the mathematics is if you lose 25%, and now you're down at a lower base, you have to make 33% just to get back to where you were, not even before you make any money. And so that's what's happening. So sometimes people's emotions get away from them. They don't realize that it's important to watch the downside.
So we'll stick with our discipline. Excellent. So that will do it for Steve and for me this week. As a reminder, all our videos are always available on our 3Edge YouTube channel. And in addition, all our written commentaries and additional information about our firm and our people, that's always available on our website, and that is 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.